Gentlemen, let's begin by taking a look at Comair. Now, Comair today reported earnings, and we saw the stock coming under pressure. The last time I checked, it was 3% down on the day. Now, this is a company that spoke some big numbers that frightened me. Let me just give you a sense of what they were. Costs, particularly fuel, up 41%. Airport tariffs up 70%. And we're also talking about a weak economy. We're also talking about a volatile exchange rate. Let me begin with you, Anthony. Would you buy?
No, we think that Comair is a very difficult business to manage well. When it's in an industry that's very difficult to do well out of. The big problem is that they compete against South African Airways, which is the full weight of the South African taxpayer behind it. On top of that, you've got very little pricing power over your input costs, and you've got quite a healthy competition from the likes of One Time and Airlink, for example. So although management team is good at Comair, we think that just the volatility in the oil price makes it very difficult for us to get any kind of earnings forecast.
Yeah.
We think that possibly if One Time goes out of business, and we expect it's quite likely that it will, then I think there's a short-term trading opportunity in Comair. But until that time happens, we would be happy to sit out waiting for that event to happen.
Sure. So this is a stock where we're talking a number of challenges here. We talk competition, which I've just mentioned. Now we're also talking, of course, about the prospect of a weak economy, and then, of course, all the other variables that we spoke about. Daniel, when you look at Comair, do you see an investment opportunity given these challenges that hopefully to ride out, or do you see a basket case where perhaps there's just no hope here, you need to move and lock your money elsewhere?
At this price, I'd say no. I mean, obviously everything has its price, so even if a business does have major challenges, if the price is attractive enough, that could be a potential opportunity. But at this price, it's trading pretty close to NAV. The return on equity has dropped significantly with these results. I'd even expect it to trade at a discount to NAV. So at these levels, and in line with the title of tonight's show, I'd say no love.
There's no love here, and he's already declared his stance on this one. But when you look at it, there is a dividend yield of 2.5% here, and at the same time, we're also sitting with a price-to-earnings ratio of about 10 times. That's too rich for you.
At these levels, yes. There are just too many headwinds against this company. And a dividend yield of 2.5%, it's not that attractive. I mean, there are a lot of stocks trading 5.5% yields with growth opportunities, not facing the headwinds that this company is facing. It's not good enough for me.
Yeah, but Anthony, what about the fact that we're dealing here with a company that is sitting in an economy where we know that the number of people who fly is extremely low and there is opportunity for growth? We're also talking about a company that's flying regionally, and we're talking about Africa having been largely unaffected by the crisis that we've seen in Europe, and therefore African economy is offering opportunity for growth. Would that not translate into some kind of upside and potential for Comair?
Yeah, I think
given their strong partner in BA?
I think that growth is heavily price dependent. I think with the high oil price, the high airport taxes, the pricing, the power that the company has to be able to fill the seats is just not there. To be able to get the growth and to get a real low cost proposition, they need to be able to cut massive amounts of costs out, which we think is very difficult for them to do. Again, they are a price taker in terms of oil price and on airport taxes.
Yeah. Now they cite, of course, in terms of their prospect, they're citing the high oil prices, which you've just touched on. They also talk about the weak economy, but they say, here's their plan. They are attacking the cost base, and they're talking about moving their staff base out to Cape Town, and they say they will save 80% on costs on that. They're also talking about catering, taking a look at that and cutting the price that they pay around that by at least a quarter. And they're talking about re-engineering the business. I'm trying to find a reason to love this stock. Surely that gives some kind of upside, no?
Yeah, I think there is opportunity for them to get more efficient in terms of the way they operate the business, to cut our costs. But if you're looking for a reason to love it, it would be if one of their major competitors went out of business. If that happened, they would have, be able to take out, all that. They would be able to grow revenue, or market share.
Sure.
And I think then they'll be able to get some real pricing power back into the equation. But until that happens, I would best avoid this thing.
Daniel?
I would totally agree. There's a difference
You're
between
not buying
growth.
the re-engineering side of it.
There's a difference between growth and
Yeah.
profitable growth. We've seen that they can grow the top line. They've got
Yeah.
pretty impressive top line growth numbers, 19%.
Yeah.
But you've got costs growing faster than that, margin compression. That's not going to make its way to the bottom line.
What about the fact that they've looked at their structure? We know that it's now one CEO, Gideon has left, so we've got Eric now totally in charge, and we also have a new chairman coming in. The previous chairman has left. So there is an attempt here to try and make this business adapt and adjust to the difficult operating environment that they have. That's not convincing to you?
Well, you need the costs or a significant portion of the costs to be manageable for a strategy like that to work.
Sure.
You've got a significant portion of the costs coming from the oil price, which is also affected by the currency, which is very volatile. I mean, those things you can't manage. Yes, you can save costs on catering, on labor, etc., but at the end
Yeah.
of the day, when the oil price peaks, there's nothing that you can really do about that. You can't lift prices enough to cover for that because the product is highly susceptible to substitution.
Yeah.
I mean, if you're flying to Cape Town, you're going to take the cheapest price. You don't look at the prices and say, I have to fly Kalula to Cape Town.
Yeah.
So, no.
Even with the potential that I'm trying to find reasons, guys. I'm waging a lone battle here. They've written off 2012 essentially because they are now looking to 2013. We know they had their first half lost in this half, and this is a proud company. This is a company that says it has had an operating profit. I don't know, since they started, I think more than 70 years ago or some such. Surely we've got to cut them some slack and give them credit that they have been able to survive in a tough environment. You spoke about the fact that they are standing up against a balance sheet that's backed by a taxpayer. Come on, guys, let's find some love. It's the 14th.
Listen, again, what Daniel said is if the price halves, then maybe
Then you
the
jump
risk
in.
relative or the potential upside relative to the risk looks good.
Yeah.
But at this price, relative to the potential upside,
Yeah.
it just does not stack up.
I'm afraid to ask my question. Okay, but I have to. Let's go for it. Love or not?
Not.
Come has no love.
Not.
Daniel?
Not.
Come stands alone. Come stands cold.